What is up, everyone? Welcome to my YouTube channel where I share my experiences on my journey to financial freedom. Before we begin, let me just put a disclaimer that I'm not a licensed financial advisor, so whatever information that I will be sharing in this video, they are purely informational and should not be treated as a financial advice or investment advice. In today's video, I will share the step-by-step process of selling put option. Selling put option is a good strategy that if you execute carefully and correctly, it can add consistent passive income that you can use to further grow your account. The first step is to pick a stable company where your sentiment is neutral to bullish. Don't just pick any other stock. Don't pick any ultra volatile stocks like pharmaceuticals and Tesla, which tend to have drastic changes in the stock price. The next step is to pick a strike price. A strike price is always out of the money. Out of the money because it's lower than the current stock price. For example, if Apple is trading at $100 per share, you will have to pick a strike price that is lower than 100. It could be 95, 90, 80, or anything lower than 100. The further out of the money the strike price is, the lower the premium that you will potentially get for selling the put option. For example, if Apple is trading at $100 per share, if you sell a put option at strike price $90, you will get a lower credit premium versus if you sell a put option at strike price $95 per share. The next step is to determine how many contracts to sell. Just bear in mind that one contract is equivalent to 100 shares. The final step of this process is to sell the option and collect the premium. So now that we've discussed all those points, let's now jump directly to trading platforms so we can see it in action. So if you can remember, the first step to this process is to choose a stable company. So let's pick Apple in this example because Apple is one of those companies who has exhibited a tremendous growth over the years. As of last close, Apple was trading at $132.05. By the way, guys, if you're not familiar with this interface, it's called Thinkorswim. In Canada, we're not allowed to trade directly in this platform, but you can still install this one so that you could perform some simulated trading as well as analysis of stocks or options. This is a pretty good platform, so I highly recommend that you guys also install this and use this as one of your tools in trading. So in your Thinkorswim, just make sure that you configured it to have a spread of single because we're only trading a single leg option. And I'd like you guys to actually just focus at the right side of the trading platform here because we're all about selling put option at the moment. So the other two steps that I mentioned earlier were picking the expiration date as well as the strike price. For expiration date, as a general rule, at least for me, I usually pick a expiration date that is at least 3 weeks away. So in this example, let's just pick Feb 12, 2021 as the expiration date. Okay. And then here, we're presented with multiple strike price options. So right now, Apple is trading at $132. So let's say we choose the strike price at 130. That means that you will actually get at least $510 as credit premium, which instantly gets credited to your account. Okay. Or let's say we choose 120 as strike price, but you will notice that I'm only going to be receiving $150, which makes sense because the farther out of the money you go, the lower the credit premium that you will receive as a credit for selling the premium. Okay. And the good thing about this Thinkorswim trading platforms, it tells you the probability, the percentage of how likely it is for you to either win or lose in this trade. So for example, if we pick $120 as the strike price, it says here it has the probability of 23%, approximately 24% of Apple stock price ending at 120 and lower by expiration date. Again, what this means is that there is 23.46% that Apple stock price will be at lower than $120 at the expiration date. Okay? So, to understand this trade better, that means that although you are only receiving $150 as the premium, you have more chances of winning in this trade because there's only 24% approximately chance that Apple stock price will be 120 or below. Whereas if you pick $130, yes, you did get $510 as credit premium, but then the probability of losing in this trade is way higher. It's almost 50% you're gonna lose in this trade. So let's just say we pick $120 as the stock price, and then let's use 150 cents as the credit premium to receive. So we're just going to select this one. And here, before you click confirm and send, the last step is to determine how many contracts to sell. So let's just put one in this example. Then review your trade again. You have the expiration date as Feb 12, 2021, and the strike price 120. Type of option is put, and then the credit is $150. Okay, so let me just explain again what this trade means. Okay, so this means that if by expiration date, which is Feb 12, if the price of Apple is not below 120, that means you get to keep all the credit premium that you receive here, which is $150. That means this option becomes worthless because the strike price is out of the money. Again, what this trade means is that if by expiration date, which is Feb 12, if the Apple stock price is not below $120, then you get to keep this premium in your account. Okay? However, it's important to note that there is a possibility that Apple stock price could be lower than $120. Okay, as we've shown in here, there is approximately 23.46 chance that Apple ends up lower than $120. So what will happen in that case? So what will happen is that if Apple stock price is below $120, that means then that you have to buy 100 shares of Apple at strike price $120 per share. Okay? For example, if Apple ends up $115 per share at the expiration date, you will still be obligated to buy 100 shares of Apple at $120 per share, not $115. Does that make sense? Okay. So, you might be thinking that at that point, you have lost $5 per share because the price of Apple is now just $115 compared to what you are paying for, which is $120. Okay? But that's not entirely true because you receive 100 or $150 or $1.50 per premium, correct? So you actually are only losing $5 minus $1.50 in this trade, even in the scenario that Apple ends up at 115 per share. So that is why the first step and the most important step of this process is to make sure that you pick a stable company, a reputable company that will allow you to recover in the worst case scenario that your put option gets exercised. So once you've reviewed the details in here, we could just go and confirm send this trade. And it will prompt you with another page or dialogue that basically summarizes the trade. So you have here max profit at $150, which is essentially the premium that you receive for selling the put option. And then you have the max loss here. Don't worry too much about it because the max loss will only be attained or will only happen in the scenario where Apple ends up at $0 per share by expiration date, which has zero to no chance of happening actually. So once you're ready, you just click send. So let's jump into Questrade because that is the trading platform that I actually use here. So I'm gonna search for Apple and I'm gonna select option here. For the option type, since we're selling put option, we'll change this to put. Quantity, we'll leave it as one contract, it means. And for the expiration, we said earlier that we want to set the expiration date to Feb 12 and strike price of 120. And the type is put. And as you can see, there are no bids and asks because at the time that I'm creating this video, it's a Sunday, so the market is closed. But just the same, I could still enter here $1.50 as the premium or credit for this option. And then we'll just click on sell. So once we have that, once we click sell, it will again prompt you with a dialog box just summarizing the trade again before you go and send the order. So it just tells you the credit that you will be receiving, which in this case is $150. The other information, the other digits in here are when you are trading this in margin. Obviously, Questrade is gonna hold some collateral on your funds to make sure that you're able to actually fulfill the obligation of buying the shares at the strike price 120 per share in the event that, again, as we discussed earlier, in the event that the Apple share ends up below $120 by expiration date. So once you are done with your final review, you just click send to send the order. And that's how easy it is to trade options in Questrade. So since I could not execute that trade because it's a Sunday here and the market is closed, I'm just going to show you the last 4 trades that I've done with Apple selling put option. So as you can see, I sold one last January 6 for $195 of credit premium. Then there's another one for $195 and another one for $100 and another one for $128. So as you can see, I received more than $500 just selling put options for Apple. So this is a passive income that's consistently I've been able to do. And these credit premiums are already in my account. So I could do whatever I want, whether I buy new shares or spend it whichever way I want. It's already in my account. So it's a good strategy as long as you exercise or you implement the most important thing of this process, which is to pick the right company. Thanks for watching the video and hope you guys enjoyed the content. If you did, please don't forget to like and subscribe. Also, enable that alert notification bell so you don't miss any of my future videos.